everybody. My name is Jeff Cohen. Thanks for having me tonight. Everyone hear me okay? Okay. We were talking before, there's a nice crowd for the summertime, and I said to Jason, you know, if somebody's coming out in the middle of 100-degree weather in July to hear about accounting and taxes for real estate, then you know that they're serious about it. So give yourself a round of applause. Real quick, I know we're starting a little bit late, and the outline, hopefully everybody got a copy of the outline. I may or may not cover everything, but this is an outline of various talks that I've done in the past and that I currently do. Jason asked me to give a quick intro on myself. Moved to Baltimore when I was 5 years old, been a CPA for 25 years, been sole practice for the last 3 or 4 years. We have an office in Pikesville, and we have 10 people in the firm, CPAs and an admin. Probably 70 or 75% of my own specific practice are all the people in this room. As Jason said, there's various people in this room that I do work with. What I'm not, and this is what Jason and Chris were just talking about, I'm not here to hawk my wares. I don't sell CDs. I'm not a national guy. I've seen those webinars, I've seen those spiels, and all I'll say about those is that they don't tell you the full story. So they're just telling you certain things to make it seem like, oh, you have to buy this book, you have to buy this CD. But what I'm here to do is really just educate. Like I said, I've been a CPA for 25 years. This is mostly what I do, work with people who are landlorders, rehabbers, wholesalers, real estate agents, you name it. So the outline here, like I said, is kind of like a microcosm of some other various talks that I do. If you want any more information on any of those, feel free to come over to me afterwards. There's an outline on some stationery, so it's got the firm name, website, phone number, my name. I have some business cards. You can grab some at the end if you'd like as well. But like I said, I want to give you some education. Hopefully we'll have time for some questions at the end. Jason, feel free to jump in too. But with that, let's just get right into it. So there's a little story that I heard recently about a doctor, and he's in the room, and the nurse comes over and she starts banging on the door, and she's like, doctor, quick, there's a fellow outside, and he thinks he's invisible. So the doctor looks at her and says, tell him I can't see him right now. So when it comes to taxes and real estate in particular, you know, there's a famous saying, you don't know what you don't know. And I can tell you that I have conversations with folks all the time. I had somebody in my office this morning who has a renovation business, and we were discussing accounting and bookkeeping, and he's just completely clueless, to the extent that I was afraid to even at that point yet get into too deep of a conversation, because he just really didn't understand it at all. So what we're not going to be able to do in the next 30 to 60 minutes is turn you all into accountants and bookkeepers, but I do want to try to hit on as many of these points as we can. So the very first question when you're dealing with real estate is, what type of entity should be holding your property? Now, that's a loaded question because obviously it depends on what you're doing. And when it comes to real estate, there's generally going to be two different categories, the way I like to explain it. There's going to be two different categories of income, two different types. You could have your ordinary type of income, you can have your passive type of income. And that's what's going to determine which type of entity you should potentially be using. So let's talk for a second. What's considered ordinary type of income and what's considered passive type of income? Passive income by law, by statute, is generally any rental income. If you're a landlord and you're renting properties, it could be the only activity that you're doing. You could own 1,000 properties. the IRS, Congress generally will look at you like you're running a passive company, passive business, which has pros and cons. We'll see how far and how deep we get into it tonight, but just keep that in mind. It has some pros, it has some cons. Ordinary business activity would include things like buying properties to renovate them and sell them, sometimes referred to as rehabbing or flipping. If you're wholesaling a property where you're either taking quick title or you're not taking title at all and you're just putting A and B together and selling it and pulling out the commission, you might be a real estate agent, and frankly it could be any other general business, right? Any contractor, any rehabber, any sub, you could be a roofer, you could be an electrician, whatever it is that you're doing, that's going to be generating ordinary business activity. We'll talk as we go through different entities. Like I said, I'm going to try to go through them quickly. What the differences are between the types of income and therefore which type of entity you should potentially be using. So as far as entities go, there are several to talk about. We have LLCs, we have S corporations, we have C corporations, we have statutory trusts, we have self-directed types of IRA accounts. And real estate can be owned in any one of those types of entities. So let's talk first about the LLC. LLCs are obviously the most famous type of entity, and when it comes to LLCs, you have to understand first, what's the point of having an LLC? I have a lot of people that come to me and I ask them, what type of entity do you have? And 90% of the time, oh, I set up an LLC. I ask them why, and they have no idea. Okay, that is what I was told to do, this is what I heard I should do, etc. So what's the point in having an LLC to begin with? An LLC is a legal structure which allows that if somebody tries to sue your company, they are not supposed to be able to get to you personally. They're stuck at the entity level. Okay, so it's governed by state law. So you set up your LLC, you don't set it up with the IRS. You're going to set that up with whatever state you live in or whatever state you're going to be setting that company up in. When you set up that LLC, again, like I said, if you buy a rental property in an LLC and a tenant trips and falls, they're going to file a lawsuit. Who are they going to try to sue? In that case, they would have to sue the LLC. And many times they're going to try to sue the owner as well, and as we say, pierce that corporate veil. But the idea is that they're not supposed to be able to. So that's why you set up an LLC. Now, what are the pros and cons of having an LLC? Well, in an LLC setting, like I said, the first pro is that you're not going to be able to get sued personally if somebody sues you. For any purpose, for that real estate. For tax purposes, now keep in mind, it's different for tax than it is for legal. The legal purpose of the LLC is for lawsuit. For tax purposes, the IRS is going to look at your LLC and say, okay, who's involved? If it's just you, that's considered a single member LLC. A single member LLC for IRS purposes is called a disregarded entity. The person is not going to file a separate tax return. They're filing their own tax return on their own personal form, and all the activity will flow through to the person's personal tax return. As opposed to if you have a partner. If you have two people when you form the LLC, that is a dual member LLC. It's no longer a disregarded entity. Now you're going to file a business tax return. In most cases, it's a partnership, and you're going to file a separate business tax return. Okay, so again, when it comes to the LLCs, there's two types, depending on who's involved, and that will determine how you're going to file your tax return. Now, what does this have to do with the type of business that you're running? Well, let's say, for example, you have rentals, right? So you could set up a single member LLC, right? I buy a rental property, I'm the only owner, If somebody tries to sue, they're going to sue the company, so these aren't supposed to be able to get to me personally. And for tax purposes, like we said, that's a disregarded entity. So that's going to flow through, you're going to report that on your personal return. And in fact, that's called Schedule E. So there's a rental form where you would put your rental income, you would put your expenses, and that's how you would report what we called before this passive income. The key to that is that there's no extra self-employment tax. Okay, so let's talk for a second about self-employment taxes. If you have ordinary type of income, you own a shoe store, for example, and that shoe store is profitable, and you come to the IRS now, you're ready to file your taxes, and you made $100,000 from that store. That's considered self-employment income. You pay regular federal and state income tax on that. You have to pay an additional tax called self-employment tax. Sometimes it's called payroll taxes. The way I explain that to people, if you're still not sure what I'm talking about, is if you get a W-2 from your employer, then you know that off the top, they're taking out the payroll tax. FICA and Medicare, the total is 15.3%, and that gets split. Half gets paid by the employee, half gets paid by the employer. When you work for yourself, you're stuck paying both sides. Okay? Now this only applies if it's subject to self-employment income. That's going to happen when you have ordinary income. So all those types of activities that I mentioned before, renovating property to sell, commissions from being a real estate agent, any other ordinary business activity, wholesaling. If that's the nature of what you're doing, you will be subject not only to regular Fed and state tax, but also to this additional tax. And that, I'm going to tie this all back to the type of entity that you're using. But when you're working with an LLC, if it's a rental, we said that's passive. That's never going to be subject to additional tax. So if you have an LLC and it's just you and you're renting properties, that's going to get reported on Schedule E of your personal return. And in that case, there's no additional tax. So you're covered legally. There's no extra point in doing anything fancy, I'll say, to try to save any other taxes. And everything works out just great. So you can do that all personally in a single member LLC as opposed to pushing it onto a separate return.
Jeff, what's the self-employment tax rate in the state of Maryland? So
self-employment is federal. It's payroll tax. It's not a state tax, it's a federal tax. It's 15.3 employer and employee. So it's 15.3. 15.3. So
do the math on that. It's a lot. You make $100,000 on a flip, 15,000 of it. 15,000 of it's getting paid out.
Yeah. Trying to find, can't find my page here. So let's talk about the other side. Let's say you're rehabbing properties, right? And let's say you buy and sell 4 properties, you make $25,000 each, you have a profit of $100,000. Okay, and let's say it's just you doing that yourself and you set up an LLC and it's a single member. So now what happens is it's a disregarded entity. But it's not rental income, so it's not going on Schedule C anymore. On your personal return, however, it's going to go on a different schedule. That schedule is called Schedule C. That's the business income schedule. Every net dollar on that schedule will be subject not only to Fed and state, but also to the additional 15.3%. So if you make $100,000, besides whatever bracket you're in for federal, let's say 15%, plus Maryland is another 7.5%, tack on another 15%. So now you're upwards of 40% in tax on that business. So what can you do about that? Well, there's several things you can do about that. And the first thing is get it off of that Schedule C. There's 2 reasons. Number one, IRS loves to audit that form. It's the highest audited form out there. And the reason is because they know that there's an additional 15% hanging out there. So every dollar that they can get back from you and deny deductions, say you didn't pick up all your revenue, whatever the case is, they're getting an extra 15%. A fellow, unfortunately, that many people know, came to me recently, about a year ago, and he said that he got audited, and he was doing renovation, and it was all on Schedule C, and the first question the IRS asks is, where's your 1099s? You paid all your subs. Let me see the 1099s. He didn't do them. So what the IRS will do immediately is deny all those deductions, which are most of them, because everything he was spending was paying his guys, and therefore no more tax deduction for that money. And they upped his income, and they said, you owe us tax on all of that plus penalty and interest. And they tacked on this extra 15%. So it's pretty key. We'll talk about 1099s later, but that's pretty key to note that Schedule C is not where you want to report profitable income, okay? So if you are a rehabber, if you are a real estate agent, or any other type of business, we said wholesaling, anything that's generating ordinary income, you from an audit standpoint, you want to get that off of your personal tax return. How do you do that? Don't be a single member LLC. If you can add somebody, it could be anybody, could be adding somebody at a low percentage, whatever the case is. Obviously each case is going to be different. Then that's the first way to A, get it off of that schedule, and then B, there's more opportunity going forward, I'll explain shortly, to be able to save taxes.
Does that include like husband and wife as a partner in a company?
So good question. So if it's a husband and wife, you actually have the choice. You can either decide to keep that as one person on your personal return, or you can call that a partnership and set it up the other way. And when you're setting up an entity, I said before that the type of entity gets determined on the federal level. I'm sorry, on the state level. So you set up the LLC with the state. You go on the SDAT website, State Department Assessment Taxation here in Maryland, and you tell them, I'm going to be a corporation, I'm going to be a partner, I'm going to be an LLC. When you go to the IRS website to get your employer identification number, that's when you get more specific as to what exactly you are. Now, if you're a single member LLC, they'll ask you, check the box. Single member LLC. If you're a dual member LLC, they'll say, check this box, are you a partnership? I see people mess that up all the time. I can't tell you how many times people come into my office, we have an entire meeting, conversation, and then I say to them, okay, so you told me that you have this set up, and this set up. Let me see the paperwork. Let me see the IRS documents and everything. And as soon as I look at it, it's not what it is. So people are confused many times because they just don't understand what it is that they even have set up.
Yeah, that's a good point, because when we do loans for a lot of people, it'll be maybe their first deal, they'll set up a new entity for it, and they need, the title company requires an EIN number, we obviously need to see an EIN number, and they just go and check this, probably don't even know what they're doing, so that's a good point. Going back to that, if you're a partnership instead of a single member, is that because if you're a partnership, you get picked up on the company level, and a single member is getting picked up at your personal Schedule C?
That's exactly right.
Got it. Okay.
So, real quick, more pros and cons of LLCs. So number one, if you're a dual member LLC, we said that everything is going to go on a business tax return. So that helps you, again, from the audit standpoint. There's also, without getting into too much detail right now, there are opportunities to save from that payroll tax. And I'll talk more in a moment about that when we get into the S corporation. Obviously, if you're a business now instead of an individual, everything on your personal, there could be some additional record keeping that you have to keep. There's some additional costs involved every year. An LLC or any other entity in Maryland has to pay $300 and file a form that's due April 15th. You can extend it 2 months. It was just due June 15th. So if you have LLCs and you don't know what I'm talking about, you need to think about that for a minute, because you might be late on those forms with the $300, and that's every year. It's an annual fee. So the other thing I want to mention about the LLC is that LLCs don't typically pay their own taxes. They're called flow-through entities. And so whatever, let's say you make $100,000 in an LLC, that net income is going to flow through to you as an individual, and then you're going to pick up that income on your own return and pay tax there. So you'll ask me, then what's the difference? It comes through on a different form. And the IRS knows, they look at that and say, oh, okay, 100,000 came from this company, and it matches, right? In their system, the company filed a tax return, it showed the net profit, now the individual is putting that same number down, and they're happy. and the audit rate on business returns is half of what it is on personal returns. So it's never a bad idea in those situations, to think about that and to put things onto the LLC and have them then flow through because they come through differently. So that's a little bit about LLCs. Let's talk for a second about S corporations. C corporations, you generally don't want to own property in a C corporation because C corps do pay their own tax, and you'll generally pay twice because the main way to get the money out of there is to pay yourself a salary. So the company will pay tax, and then you'll pay again when you pay yourself that salary to get the money out. So you don't really want generally to use C corporations. S corporations are similar to LLCs in a sense that they're flow-through entities, and so they don't pay their own tax for the most part. And again, when it flows through, it ends up on a separate form, so you get all that benefit. The main difference between the S corp and the LLC is, number one, you could be the only owner. You don't need anybody else. You could be one person, 100% owner of an S corporation. Number two is that in an S corporation, the officer, the owner of the company has to pay himself a salary. So in an LLC, I didn't mention, you don't pay yourself a W-2. That's not how you take the money out. I'm jumping around a bit on the outline, but you don't take the money out of an LLC through wages. All the money is yours. All the money is subject to tax, if there's profit, obviously. And when you take it out, it's an owner draw. It's just your money, okay? So you can just take it. People ask me all the time, well, let's say I'm flipping properties and then I take the profit and then I put it into the next deal. It's your money. You could have gone on vacation with it. You still have to pay tax on it. You chose to use that money to do the next deal. Somebody asked me that today. So that's a little bit about the difference there between the LLC. You don't pay yourself salary, but in an S corporation, it is a corporation. It's more rigid. There are certain rules that you have to be wary about. I'm going to mention one trap in a second. But the biggest key to the S corp is that you, as an owner, pay yourself a W-2. So let's say you are like renovating houses, like we said before, and you sold 4 houses this year and you made $100,000. If you're on a personal Schedule C, we said, you're going to pay Fed and state plus 15%. If you're in an LLC and it's just you, no difference. All you get is the legal protection. If you're in an LLC with 2 people, pretty much the same thing, but there are some tricks of the trade that we can try to get out of some of that extra tax. But if you're in an S corporation, you're going to pay yourself a salary. It's only on the salary that you're going to pay this extra payroll tax. So say you had $100,000 of profit and you paid yourself $40 as a W-2. You will pay the extra 15% on the $40,000, but not on the $60,000 that's left over. Now you will pay income tax on the whole thing. On your personal taxes, you're going to have a W-2 for $40,000 and a K-1, which is the form that reports the business income to you personally for $60,000. You're still going to pay federal and state taxes on the full $100,000, no matter what you do. But under this scenario, you're only going to pay the 15% payroll tax on the $40,000, not on the $60,000. So you saved $9,000. Okay? So if you get nothing else out of our little chat tonight, if you get this, it was worth coming. Let me say it one more time. If it's an ordinary type of activity and you're in an S corporation and you pay yourself a lower salary than the full amount of income, you're going to save 15% on what we'll call the non-W-2 piece.
So that non-W-2 piece is still going on a K-1, right? Is that called a distribution or not?
Yes. So you
so you take that investor takes that out as income. I mean, why, okay, well, let me ask you a question. Why not just put all that money as a W-2? And what's the...
You say, why not put it all not as a W-2?
Yeah, why not all as not W-2?
So good question. So the IRS says that if you're in an S corporation, you need to pay yourself what's called a reasonable salary. Okay, so the first thing the IRS does when they get an S corp return is look to see what the officer comp line says. It's probably something that goes through their computer system.
If people already have LLCs set up, can they file as S corps?
Yes.
And change it?
Yes. You can, not only can you do that, you can do it retroactively too. So I have people come to me all the time in January and February, and it turns out that they either rehabbed or they're a real estate agent and they have an LLC set up. we can file a S-Corp election retroactive to the beginning of the year, last year, and do all of this. The only thing to be careful about is the salary. There are guidelines as to when you have to file payroll tax returns. So you can't now come and say, well, I want to do this for 3 years ago or 2 years ago because you didn't do the salary.
So what's the downfall if someone's already an LLC and they think everything's fine? What's the downfall of doing an S-Corp? Or is there no downfall?
There's really no downfall.
So your advice to most people, not everybody, but most people is when you have whatever, short-term capital gains, ordinary income, a flipping business, not passive stuff, just a flipping business to do stuff either in an S-Corp or an LLC following as an S-Corp. Because the big protection, the big legal advantage, the tax advantage is you can take that money out as a W-2 and you prevent it's just the ordinary income tax. It's the self-employment tax.
Is limited. Correct.
And in an LLC, you're getting full tax on that as your K1, as your distribution.
Correct. Okay. Now again, that's true in many cases. Yeah. I can't say it's true in all cases, and there are other ways to get around it as well.
Got it.
That's not the only way.
Perfect.
But keep in mind, that's only for ordinary activities. This is not for rentals.
Yeah, I was going to say, so to keep this moving forward, does it make sense for an investor who's flipping a property, who flips properties and they also own a rental portfolio, to have 2 different entities, one for each?
Absolutely. Absolutely. And one of the traps I said that I was going to mention is that, again, we don't have time to get into all the nuts and bolts, but when you have rental property, what do you typically do? You refinance it, right? When you refinance, you should not have to pay tax on that refi, right? Because you have new debt. There are traps in S corporations that could come out that you would have to pay tax on that. And so it's not recommended to have rental properties in an S corp for that reason. And so I am very careful when people ask me that question. Should I have multiple entities? Am I ready yet to create an S corp, or should I start as an S corp? You know what happens? People, this is the most common thing that I see. People come to me, they sit down and they say the following: I'm getting into real estate, I don't have a lot of cash, I can't borrow too much, I'm going to buy, rehab, and renovate and sell 2-3 properties, put some cash in my pocket, and then I'm going to go buy some rentals. I hear that all the time. Until they buy it, fix it up, and realize it's not selling. So what do? They stick a tenant in it. Okay, so to jump the gun and to start setting up this type of company or that type of company when things could change could be hazardous. Okay, so again, I'm cautious. I like to take baby steps, and these are the types of things that I explain when I sit down with somebody. Make sense?
Yep. Do you want to jump in with the pros of buying rental properties in one entity? In a certain entity? Or?
Sure. There's a couple aspects there when you're buying several properties in one entity. First of all, lenders have limitations. So they might say, we only want you to own 3 or 4 in one, or they might have caps. That's number one. Number two is you should be wary when you're owning rentals. Are they leveraged? Is there a mortgage on them? Is there hard money on them? Do you own them straight out, free and clear? And are you concerned about any tenants in particular in any of those properties where if somebody sues you on property A and wins, they can now take property B. If the property has a lien on it from a mortgager, then they can't really take that property. So it might make sense to put 2 or 3 of those types in one company so that they're just protected and you have some insurance and you feel comfortable and confident. But if you have 2 properties in the same LLC, one is owned free and clear and one's not, and the tenant in the one trips and falls and sues you and wins, and they're going to grab the other property, that's a problem.
Yeah. So another thing that I notice a lot of investors do, Mark, I'll jump to you right next, but a lot of them set up single-purpose entities for every property that they purchase. So they'll buy a property, they immediately set up, Jason 123 Main Street, Jason 1234, whatever, over and over and over. Like, what's your thought process related to that? And a lot of people have other reasons besides tax savings and accounting reasons, they do it because they're not sure what they're going to do with the property. They may sign it.
Right.
They may do a straight assignment of the entity, and they obviously can't do that if that's their core business, their core entity. They don't want to assign that to somebody else in order to flip it. But like, what happens related? Like, what's your thoughts about doing that? Do you have one shell LLC that owns all these single-purpose LLCs? Or just
so again, the first thing to think about when it comes to that is if somebody sues, at what level are they filing that lawsuit, and which way can they go? Can they go upstream? Can they go downstream, or side to side? So if you have one shell, master company, right, Main Street, group, whatever, and a lot of people do this, and then they have all their various LLCs under it, and they call it, mainstream, they're trying to build a brand. I see that a lot. From a legal aspect, again, I'm not an attorney, but from a legal aspect, what you want to give thought to is who owns what and how are they owned, and if somebody sues down here, right, but this company is, only owns one property, but can they go up? Right, and many times they can't because that company doesn't own what's above it. But if they sue above it, then they can drop all the way down to everything that's owned underneath it. So it's not a question to answer easily. Everybody's situation is going to be different, and obviously between your CPA and your attorney, I think it's something, if you have that situation, to go through it, to think about. But again, this is important, there's two separate parts. There's the legal part, which is what you're saying, and there's the tax part, right? If you're not worried about the legal part, as the tax guy, I might say, well, you can have your master and you can have all these little separate single members. We'll wrap them all up and file one tax return instead of having to file 10, right? Or you might say, well, I don't know what's going to happen in this company, in this company, in this company. I may do this, I may do this, and then you may not want it that way. You might be able to set it up ahead of time where it can be changed down the road if things change.
Exactly. Hi, Mark, do you have a question? And then if anyone else has any questions related to entity structure, and we can jump into that. If not, we got a few other things we should go. We'll jump down there.
Yeah, my question was, so let's say you have a free and clear property, which whatever your acquisition paid it off. Would you recommend us recording a deed of trust of X amount of dollars that we own deed of trust on, just to have, like, it's saying that there's 100,000, like, say it's worth 120, we put a deed of trust for 100,000 that we own the deed of trust on.
Again,
you want me to repeat that question?
Yeah.
Did you get that question?
Not quite.
Okay. So his question is I own a property for 100 grand, and I'm assuming it for asset protection.
Yeah.
I put a loan against myself for $100,000. So it looks like creditors or for anyone else, they could potentially, maybe it's a rental property, you don't want a tenant to sue you. It looks like it's already leveraged up.
Right, okay. I mean, people do that. You have to have the ability to do that. And if you do, and you're willing to have the debt out there, or, whatever the arrangement is, yeah, I've seen people do that. Would I recommend it? I don't know. It would depend on each situation, I think. Yeah, I mean, it's just...
But do you even need to have the ability to? Because can't you just follow it, follow a deed of trust without...
There's no note with it.
Big consideration.
Like I said, I'm not an attorney, but what I always see is if somebody wants to go after you, they're going to go after you, and they're going to put every single person and every single company and every single everything on there and make you prove, that it's not real and that it's really not yours. You know what I'm saying? Yeah. Go ahead.
Could you go back into the single member LLC and why it's advantageous to add somebody else at a smaller percentage potentially, and how that...
Yeah, I mean, quickly, the two reasons would be, one, to get it off of your personal return. Okay, so from an audit standpoint, and then from a tax standpoint, again, because you're subject to the full extra 15%.
You're paying 15% more because it's showing up on your Schedule C of your personal return, and that's not happening in a partnership return.
That's right.
So Schedule C's get looked at the hardest on personal. That's the first one, and then the second one is you take away the self-employment tax.
Potentially. If you're in an S corp, for example, then you would only pay it on the W-2 piece.
Multi-member, I was sorry, I was comparing single-member LLC to multi-member.
So, okay, so yeah, there are ways, I don't want to get into it now, but there are ways in a multi-member to do it differently than in a single member, yes.
And piggybacking on Ian's question along with that, is the wife a good person to do that?
Yeah, definitely. Now, quickly on statutory trusts, can we touch on that for a second? It's another entity, part of the entity conversation, but I think it comes back to what you're asking me, Jason, about all the different properties being owned under one umbrella. And what I have is I have several clients that are renovating properties and they have a lot going on, and they'll set up a statutory trust. Now, Delaware used to have what was called series LLCs, and so Maryland, in an effort to kind of copy that, came out with these statutory trusts a bunch of years ago. The general idea was that you set up one trust. It's not a real trust. I'll explain that in a moment, but you set up a trust and you name the beneficiary, and then you only have to pay the $300 for the one. You don't have to do for all the sub-trusts. So instead of an LLC and a bunch of LLCs owned under it, you have a statutory trust and a bunch of sub-trusts. So I have probably, my largest client is one of the largest landlords in Baltimore City, and they have this elaborate structure. They really did it for estate planning purposes, but they have statutory trusts, and then under it they have sub-trusts, A, B, C, D, and each one of those own a bunch of properties. And the point is, number one, when I picked them up as a client, they were paying $53,000 every year to the SDAT in $300 fees because they had over like 200 entities. Now we file about 60 to 65 of them. So they cut that number, a third. That was one thing. But number two is what you can do if you're doing development is you can carve these out and then sell off these sub-trusts. Okay. The key is when you have these trust documents set up that you have the beneficiary in there correctly. So if you tell it in the document how you want it to be taxed. So if you want to be an S corporation because you're renovating properties, the beneficiary has to be set up that way. It would default to you personally. And I had that happen where an attorney set it up, didn't write it in, and when we were doing the taxes, I looked at the document and I said, this is you personally. We amended the document and we put in there that we wanted the beneficiary to be her S corporation. So, and attorneys who do know, how to use these have told me that they work great for people who are doing development. So if you're buying a big plot of land and then you're carving it out and then you're selling them off, that's what those are really good for.
So I want to spend some time on depreciation a little bit, but real quick, can you just fly through what is classified as a real estate professional? Because I'm guessing that 95% of this room does not know what that is.
So what we talked about the fact that if you're a landlord, you're in rentals in that business, that by law, by statute, that's passive. Okay, now what does that mean? Number one, we said it means that you're not paying the extra 15% tax. Okay, but number two, the IRS doesn't want people investing in real estate companies to generate losses to then go and offset those losses against all of their other income. That's what was happening. Okay, I always explain tax law as follows. The government comes out with a rule and then everyone figures out how to get around it. So then they try to close that loophole and then everyone figures out how to get around that. And that's why we have the round and round that we have with all of the tax rules. Interestingly, and I have it on here at the end, but I'll drop it on you real quick and then I'll get back to what we were going to talk about. Everyone's talking right now about the Republican tax plan and what the president wants to do, right? Well, very simply, all he really is talking about, and anything can happen, is that he wants to make things simpler. Well, what does that mean? Well, he wants to make 3 tax rates. Right, so right now there's a lot of tax rates. He wants to make 3 tax rates, from here to here, from here to here, and here to here, and that's it, right? All the rest of these rules aren't really going anywhere. It would take a tremendous amount of time and years and years and years for them to figure out how they got over the last 50 years from where we started to where we're at, more than 50 years, right? And to undo that in a way that wouldn't hurt the government. It's almost impossible. I think it's almost impossible. I don't know how they would possibly do that. So even if they come out with that and they do lower taxes for some, and maybe it hurts the middle class, whatever it might happen. I don't think any of these rules are really going anywhere. And I think that this discussion about real estate professional and passive rules is a great example. Code section 469 on the Internal Revenue Code says that there are 3 levels, basically, of real estate professional, okay? Now, when I say 3 levels of real estate professional, what I mean is your activity. There's 3 levels of activity. And I always like to explain it as the bottom floor, the middle floor, and the top floor. If you're in the bottom floor, you're an investor. I don't really own anything. I have money. I give it to so-and-so. I own 5%, 10%, 50% of his real estate, and now I get a K-1. My K-1 shows that I lost $50,000. Now I want to take that $50,000 and put it on my tax return to offset the $1 million that I make from my other company, right? And the IRS says, no, no, no. If you're passive and you're not involved, you can't do that, okay? And if you have no basis, you're not at risk, and we're not going to get into all these rules right now, but if you don't have any basis, you're not at risk, and you're passive, you don't get any of it. Now, you can carry it forward, maybe get it in a future year, but for this current year, it would just be frozen, okay? That's the ground level. The middle level is what we call active in real estate. If you're active in real estate, that means that you spend at least 500 hours a year on real estate, and you're actively involved, you have a say, you're not just a limited partner, which gets back to LLCs, but again, that's another discussion. And basically, if you are in this middle boat, what the IRS says is, as long as you have enough basis and you're at risk, you're active, we'll give you a little bone. We'll let you take up to $25,000 of losses. So if your K1 said minus 50, we'll give you 25, the other 25 will carry forward. The caveat to that is our income limitations. So as soon as you make $100,000 for the year, overall on your taxes, that $25,000 starts to phase out, 1 for 2. When you hit 150,000, it's gone. Okay, so the problem then is, I had a client once who she owned 20 rental properties, and she was showing losses on those rentals, but she had a day job and she made a good money in a government job. And I said to her, well, you make more than 150 and you cannot take these losses. And it was like the first year that happened, and she was just, blown away by that. So she says, well, what do I have to do to be able to take them? I said, well, you're in the middle bracket here of the 3 floors. You need to hit the top floor. That's called a real estate professional. She says, well, how do I do that? I said, well, there's mainly 2 tests. Number 1 is you need to spend more than 750 hours a year on your real estate. And she says, well, I do that. That's only 14 or so hours a week. I said, and the second test, and it's not an or test, it's an and test, 750 hours, and more than 50% of your time has to be in real estate related activities. Now, there's a definition for real estate related activities. But if you have a day job and you have a W-2, you're not going to meet that 50% of time test. And the government, the tax court has time and time again shot that down. People trying to say, no, I'm more than 50% of my time. And the answer is always, no, you're not. So if that's the case, you can't take the full amount of the loss. If you can prove that you're a real estate professional, then you're no longer subject to those passive rules, even on the rental losses. And now you can take even in excess every year of the 25,000. There's no limitation. The real estate professional rule, again, that the tax court is telling everybody, you have, if you have a day job, you pretty much can't do it. As I mentioned, there's a definition. What is a real estate professional? Okay, and without having the definition in front of me, I'm not going to take a shot at it, but basically what it says is that you have to develop, redevelop, construct, reconstruct, etc., real estate, okay? Real estate agents count. If you're landlording and that's all you're doing, that counts. If you're flipping, rehabbing, and that's all you're doing, that counts. But if you're an appraiser, or you're doing something as a service, it's in the real estate world, but it's not direct. My feeling is those don't count. If you read the description, I read this to a client of mine who's an appraiser who has a lot of rental properties, and she's like, yeah, I don't think that's not me. So that's just something to keep in mind, but again, it's going to be on a case-by-case basis.
Yeah, so I want to take a break in a second, but let's try to get through depreciation real quick.
Okay.
Depreciation is important, and I think so many people do not understand exactly how it works.
Okay, so one of the things that I like to tell people is as follows. When you look at a Schedule E, which is the rental schedule, or on a partnership return, there's a Form 8825, which is basically the business version of the Schedule E. The IRS says, give us your rental income, list all of your expenses, and then you're going to pay tax or take a loss at the bottom, whatever, if there's a net income or not. But you might have positive cash flow, and at the same time, for tax purposes, you might be able to show a loss, which is where all these rules come into play, because people are trying to generate these losses to offset other income. So the biggest area is depreciation. There's other non-cash type of things, mileage, for example, or other what we'll call non-cash type of deductions. Excuse me. But the main one is depreciation. So in order to calculate depreciation, the first thing you have to understand is what's your basis in property, right? Even before that, you have to understand that there is no depreciation on ordinary type of income. So if you buy a house to fix it up and sell it, you cannot take any depreciation. Depreciation is only if you're buying a house, for example, as a rental property. If it's a renovation, it goes into the cost and it stays there until you sell it, and then it goes into the calculation of the gain or loss. If you rent property and you buy a house and you purchase the house for $100,000, you cannot just write off $100,000. You have to calculate the basis of the property, and then you can depreciate it over a governed amount of years. When I say calculate your basis, you bought it for $100,000. A big mistake people make, and I see this every day, is they get their settlement sheet, they get the HUD one, and they look at the bottom, they're doing their bookkeeping, and bottom it says cash from borrower, right? So the property might have cost $100,000, but the cash from the borrower was something else. And that's because there's a lot of things on that settlement sheet, and they keep changing them every couple of years. They think they're making them easier, and they're making our life miserable. But there's settlement costs, there's ordinary costs that flow through that are taken through escrow, whether it's insurance or taxes. There's seller, takebacks. There's all kinds of things that flow through that settlement sheet. The number at the bottom, when you're coming to the table with money or receiving the money, that is not your cost. That is not your profit if you're the seller. It just doesn't work that way. So you take the cost of the property. Let's say it's $100,000. You want to figure out what your basis is. The first step is to calculate the difference between the building and the land. You cannot depreciate land, okay? So let's just say it's 10%, and you say, okay, 10% of my $100,000 is land, I'm left with 90. Well, now you have settlement costs, you have other costs, you can add all that back in. To make it easy, let's just say you're adding back another $10,000. Now you have a $100,000 basis in this property. The IRS, Congress says that the useful life of a residential real estate is 27.5 years, and commercial property is 39 years. It's pretty much going to be straight line, which means that you're going to divide out that cost basis, in our case $100,000, by that amount of years, and every year you're going to get that little piece, okay? So let's say you're getting a few $1,000s of depreciation, and your property is cash flowing, and you're making $1,000 or whatever it is. On your tax return, because of that depreciation, you're going to end up showing a loss. And that's really what we're talking about here. So in a nutshell, that's how the depreciation works. Now, keep in mind that the IRS has given lives for all of the different types of property. So if you have a rental, for example, and you buy appliances, you put in carpet, the IRS tells you how long that depreciation is going to be for. It's not really up to you. The other thing to mention is there's something called allowed or allowable, which means you cannot just choose not to take the depreciation. If you don't take it, you lose it. So you have to take it. Okay? Now, we're not talking about this right now, but they get you on the backside. When you sell it, they make you recapture and pay them back for all that deduction that you took. But keep in mind, again, that it's allowed or allowable. And I find many times, and this is another very key thing to keep in mind, again, you know, to a couple of things, if it's all you come away with, it's worth it. I review returns all the time. I'll review anybody's tax return, no charge. Email it to me, I'll take a look at it. I always find something. Question is what? Many times I find that there's no depreciation. It's the craziest thing. They just never took it. You are allowed to catch it up all in one shot. Now, depending how much it is, it could be a little bit more complicated. You might have to file some additional forms with the IRS, but it's an automatic approval, meaning you file the form, you tell them this is what I'm doing, and it's done. I had a trucker who came to me, and I was looking at his tax return. He was on a Schedule C, and he bought a truck 10 years earlier for $110,000, an 18-wheeler, never took any depreciation. And we took it in one shot. We filled out the forms, we gave it $110,000 tax deduction in one shot. Lasted him a couple of years, but it was, you know, as losses. So again, that's just a few tidbits there about how depreciation is calculated, how it works, and a couple of rules that I think are, you know, important to know.
All right, so
Take a question?
I have a multifamily building that has 3 residential units and a bar on the first floor. Is it a residential property or a commercial property for depreciation?
Mixed use. Do you keep track of each of those separately?
Maybe I do.
Well, if it's done right, you would calculate the rent on each part separately and the expenses, and then you can allocate and put a piece to residential and a piece to commercial.
And supposing I didn't do that, would the IRS ever send me a paper audit for that?
I mean, again, the difference between the 27.5 and the 39 is probably minimal, you know, and once it's fully depreciated, it doesn't matter anymore anyway, so it really would just depend on the numbers.
Does the depreciation you're speaking of, if it comes out as a net loss, does that go back to your real estate professional topic you were just discussing prior to?
Yes.
So you have a full-time job and you have 20 properties.
Yes.
And your depreciation is more than,
Right.
you don't get it.
Well, you wouldn't get the loss, you would have to carry it forward. I had a client once who insisted every year that we write a cover letter with his tax return that he was providing to the lender to explain depreciation, because I don't want to throw any lenders under the bus. I see several of them in here, but the ones in here are excellent, but there are lenders, believe it or not, I know it's hard to believe, that have no idea how to look at a tax return. And so when they look at the tax return, they say, oh, well, you lost $100,000. And the guy says, well, I have 50 properties and I spent $2,000 on carpet in every single unit. So it's all just the depreciation that I took on the carpeting. And they couldn't understand that. So we had to get involved.
So you're saying, follow up on Ian's question, if you're not a qualified real estate professional, you can't take the loss. You can depreciate everything down to your tax return to be 0, but you can't take the loss, but you can carry that over to the following year. So if
correct.
If you have a W-2 income and real estate's not your full-time job, but you have a lot of rental properties, if you use rental portfolio, you can get your tax basis or net income down to 0, but you can't go negative.
If you're not making over the 100, 150, yeah.
Okay.
Yeah. If you're under 150, then you can still get something for it.
On that same question, does it change if you own the real estate in your personal name versus in a business entity?
No.
So is the rub really you need to have passive gains to offset the passive losses? Is that really what?
Yeah. Under the 469, if you have passive income, then you can offset the passive income and passive
Otherwise
losses.
it carries over to a
Correct.
future or whatever that.
Correct.
I just may want to make a comment that I had been audited for the passive income deduction. It wasn't enough that I just had a real estate license. I had to send in a copy of my broker's license and prove that I was managing. So a lot of people are trying to get real estate licenses to skirt the law.
Yeah.
And
Yeah, that's a great point. I don't know if y'all heard it, but I'll tell you a quick story, and then I don't know if you want to take a quick break. But I'll tell you a great story which give you a really good insight into this topic in particular, and some of the things that we do, right, as tax professionals, as opposed to, I hate to say it, but putting your stuff into TurboTax. Okay, and that is the following: I have a client who wanted things to look a certain way. It wasn't wrong. So I told him, you know, I think we can do this, but I am not convinced that this is not going to be a red flag, that the IRS might want to take a look at this. And sure enough, that happened. And so when I went downtown to meet with the IRS agent and we were looking at the issue, the very first thing, if they look at a rental schedule, you know what the very first thing that they want to see is there a number on the management fee line? On the schedule, it says lists all the expenses. One of the ones that is on there that's in, you know, a specific line says management fees. If you have a number on the management fee line, the IRS will say to you, you're not active, you're not involved. You have a management company. Right? So my comment to them was that this particular person was retired and he was doing all of the rehab, fix-up, anytime there was a maintenance call, he was the one taking care of all of that himself, and that even though he was paying a management company, he just didn't want to collect the rents and deal with the people, but really he was doing the bulk of the work. I never put anything on that management line again.
Yeah, all good stuff, Jeff. Yeah, I know in general, talking taxes, talking about all this stuff is not the sexiest conversation. Everyone is more concerned about talking about making money and finding deals and raising capital, and that's all good. But I'm just like everyone else, we all work very hard for our money, and I like to keep as much of that in my pocket as possible. So knowing these things, refresher course, Jeff obviously knows what the heck he's doing. I think everyone can see that. But like I said, we all work hard for our money. Let's keep as much in our pocket as possible the legal way. Do it the right way by following the codes. I mean, a lot of this is not because it's just, you know, you don't know. you don't know what you don't know. Right. And things change as well. So I think it's all important. And it's not just, you know, like you said, I mean, there's somebody who owned 250 units and they weren't even 100% sure. So it's not just for a newer investor. It starts with a newer investor to make sure you're setting it up the right way. Because, I mean, Chris and I will tell you, you know, it's one of those things, you know, we started Hard Money Bankers 12 years ago and, you know, we started making money, we started making good money, and then it got to the point of it's like, wait a second, some of the 101's not even right. You know, we restructured all our entities, we set this up, and it was just things that, you know, who knows? You could have lost a lot of money along the way that we didn't even realize just because we didn't set it up the right way. That wasn't something we were concerned about. We're just concerned about being active, doing deals. But I'd much rather do less deals and make more money than just do deals to do deals to do deals and not know where the heck the money's going.